So I'm actually with Warner in Denver, so they flew me in for this, so hopefully I do a good job here, but I think you guys are going to like this. It's a good presentation. If you guys are familiar with level funding, it still has some pretty good concepts in there that are a really good refresher on a lot of different things. So we'll go through a bunch of it. We'll talk conceptually about differences between level funding and like an ACA fully insured product, and focus really on small group and the concepts of level funding in basic terms. But hopefully you guys will each have something that you can take from this today, but I think you guys are really enjoy it. So a little bit more about myself so you guys understand where my experience with the product comes from, and you can take whatever I say how you want. But I work for Warner as a sales executive for alternative funding. So I focus on being an expert with anything that would not be considered fully insured. Level funding, bundled and unbundled, self-funding, RVP, both full replacements, partial replacements, captives, anything that falls outside of that ACA small group fully insured market and large group as well, falls to myself. So, it looks like we went too far forward here. So what I do is I work with our sales teams in our primary markets, California, Colorado, and Texas. And in each of those markets, level funded is going to be slightly different based off of StopLoss laws, which is the one thing that states can regulate with those products. Beyond that, I do a lot of work with our carrier partners across the country, even outside of our actual primary market. So I'll work with, I've worked with Anthem, I've worked with Kaiser Permanente, done some stuff with UHC in Colorado and in other states to basically kind of improve, change, and help them continue to implement different technology solutions within the products, and even help them launch them into markets across the country. So all of that has kind of culminated into also doing these CE courses. So I try to take the experiences that I have and deliver them to you guys, but it's really more of a national perspective. There's going to be some stuff that we can talk about that's specific to Texas, but really the presentation covers level funding in general and the way that you'll see it across the country. So it's some pretty good information. Some of the things we're going to talk about, we'll go really into one, why would you want to look at level funding in small groups? We'll talk about the advantages, we'll go through all the different pieces, and then we'll look at some of the different product options that we've been seeing across the country, both bundled and unbundled, and we'll talk a little bit as well about what that actually means when you're creating a bundled versus an unbundled product in level funding. We'll then talk about some risk rating. So risk rating is basically introduced when you look at self-funding. Right? If you look at small group fully insured ACA, it's community rated. So we'll talk about risk rating for level funding, what it means, how do carriers do it, the different ways and methods that they utilize, and the impact for you guys in terms of the experience, the requirements, the timeline for yourselves and for your clients. We'll also look at the rate breakdown. So basically, when you get into out of fully insured into level funding, you'll see that you start to get some transparency behind the rate. We'll talk about that breakdown and how carriers range it differently. Then we'll get into the actual, how the product functions. So we'll look at the stop-loss pieces, both individual and aggregate stop-loss. We'll talk about how those work. And then we'll get into surplus and deficit, how that's handled, surplus arrangements, surplus shares, and then we'll talk a little bit about terminal liability, run-in, run-out, those types of things. So let's move into it. So when you look at level funding, it's in the small group market. What they're trying to do, carriers trying to do in the offer is they want it to kind of look, feel, and act like a fully insured plan. Meaning you're not necessarily paying for claims like in a true self-funded arrangement where you're paying actual claims throughout the year. What you're going to be doing is paying a pre-funded maximum liability, right? So what they do is they try to figure out what is your maximum liability. It's set by the aggregate stop loss and individual stop loss. You pay up to that, and you pre-fund it as a premium you pay to the carrier instead of paying it as you go. Typically, when you look at these contracts as well, you're going to have runout included, especially in a small group. And so on your contract, on your quote, you'll see something like a 12 1218 or a 1224, 1236, 1260, that means that they have runout included in the contract. When you get into true self-funding, you have more of a 1212, and you can purchase runout if you exit, or you can move to a new contract and purchase run in from your new carrier. But typically with level funding and small group, you're going to have runout included in the product and included in the rates and paid for when you actually move in and purchase that product. The next is the notion between a split liability between the carrier and the employer. So when you are self-funded, which level funding is, it's a product of self-funding, the employer is actually liable for paying for claims. In a fully insured arrangement, there is a transfer of risk when you purchase an ACA or a fully insured arrangement, and it transfers from the employer over to the insurance carrier. But in level funding, what they do is they kind of include the stop loss automatically, and in most cases you will not have the option to not have it in the product. And it creates this sense of split liability between the employer and the carrier. The employer is going to be responsible for paying for claims up to a certain amount, at which point after that, the stop loss insurance carrier is going to be paying for claims. So you have this split liability. Another characteristics of these plans is what we talked about before, which is rate transparency. When you're on a fully insured product, you're just going to have your tiered rates or your age-banded rates. It's just a total number. Let's say it's $600 for the employee-only tier. That's all that you get. In level funding, you actually get introduced to the concept of where is my money going before I decide to spend it, right? And we're kind of building it here on the right. For that $500 or $600 employee-only rate, they'll show you, okay, $300 is going to the claims fund to pay for claims. $200 is going towards stop loss. This amount is going towards the admin fee. So you gain power through that by having insight into where your money is going, and you can use that when evaluating different options, unlike you could do in fully insured. You also get introduced to customization, right? So if you're looking, and I'm talking specifically related to the ACA market. You look at a fully insured ACA plan, those plans and rates are predetermined, they're filed, the DOI, and then they're released, and you can go onto a rating engine, you can quote, right? But they're going to be canned benefits. When you get into level funding in small group, you're going to get introduced into customization of benefits. Some carriers will not give you any customization. Some will have you do full customization, saying we don't have canned benefits. Tell us what you want, line by line, or give us something we can go off of, a previous SPC. And others will fall somewhere in between. Maybe they have canned benefits, and they allow you to make customization retroactively after the quote. But really what you're doing is you're first now getting into the concept of customization, which is really important in terms of driving utilization in the direction that you want. And I'll get into more about how that's done, how you utilize it. The second piece is claims information. Now I know here you guys have HP 2015 data that you can access, correct? So I know that you guys are well ahead of other markets in terms of fully insured what you have access to. But still, depending on the carrier, you may have more detailed information at your fingertips, right? So you might get a mid-year report, you might get an end-of-year report, then a separate report in the renewal, and you have access to all these different claims data, monthly aggregate reports, large claim in detail. All of this stuff is something that you're going to get when you move from an ACA product, fully insured, into the world of level funding, depending on the carrier, right? So each carrier is going to have different reporting. They're going to give you different levels of access to information. But really what it does, in combination with customization of benefits, is allows you to look at it and say, okay, if I know I can change and customize the benefits in my plan, and I'm getting information that's telling me that my plan or my group's plan spend on ER is 10% higher than the national average or the state average, I know that I need to drive utilization away from that. Maybe that's an educational opportunity, right? You go to the group, you talk about, hey, you can actually be utilizing urgent care versus ER, right? And that's going to very greatly impact plan spend. So those are things that you can start to do. Those are initiatives that you can set out on that really will kind of take the control back and allow you to curb that spending long term. The last concept is surplus shares. And I say shares because depending on the carrier, you don't necessarily get all the money that is used. In self-funding, you're paying claims as they're incurred, and you're realizing those savings in real time. In level funding, where we talked about the first part, is you're pre-funding maximum liability. The reason that you're doing that is that just like if you came from a fully insured product, you're paying a premium on a monthly basis, regardless of how you're doing. The carrier is holding onto that money, and they are paying for claims out of that claims fund. At the end of the year, if there's money left, some carriers will give you all of it, other carriers will give you a part of it. Maybe they'll give you 2/3, maybe they'll give you half. It's important to understand what those actual arrangements are, depending on the carrier and option that you're looking at. But when you move to level funding, you have a chance to save and get back some of the money that isn't spent for claims for your group. And that's a new concept, obviously, coming from ACA. Any questions before I keep moving on into more detail? Yes.
Comment why I like it so much is it's easy to sell a high renewal as well if they don't specify, because you always say, well, it's not true, that money's going to claim fund, you're getting your money back.
Yeah, I mean, that's another good thing. I'm going to get into some of the advantages pieces here. I think the renewal aspect is obviously interesting as well, right? So at new business, you're getting rates that are specific to the group, right? It's not going to be a community rate. That's the same thing at the renewal, right? You can take the information, you can take whatever the experiences you're having with the carrier, and you can bring that into negotiation at that time. But in general, it's a really good selling point that if, in self-funding, your cost is equal to your utilization more or less, right? Level funding, there's a lot more that goes into it, so it's not exactly one-to-one, but still, it's moving in that direction. If you can trend or you can impact your utilization downward, you're going to impact your cost. Some of that's going to come back your way. So it's basically, if you do good, you can share in some of that success, is the way that you would just put it. Any other questions? Okay. So some of these are going to repeat, but I didn't want to take this slide out completely because I think there's a couple of good things in here. So rate transparency we talked about, right? Each quote, you're going to be able to say, why are you putting this amount of money here instead of there, right? And you can make the decisions based off of how you're seeing the allocation of your money. Lower premium taxes, so you're paying taxes on the stop-loss portion of the rate, not the entirety of the rate, so you're going to lower premium taxes relative to the ACA. There's no state-mandated benefits. So on the ACA, you have benefits like bariatric surgery and pediatric dental, and some others. I don't know them off the top of my head. But they're mandated to be in the ACA plans. When you move to a level-funded plan, they don't have to have those benefits in there. Some carriers will include those benefits in there. Others, they have customization, and if it's something that's important to you and to your client, you can add it in. But typically, if you have a carrier that is offering ACA fully insured plans and level funded plans in small group, there will be a list of benefits, and sometimes they have it on a flyer that show you the differences in those state-mandated benefits that are not included. But you should be paying attention to it. It's a good thing because if you don't need it, it's going to drive the cost down because you're not providing coverage for it. But if you do actually need it in the plan, you need to be having the conversation with your clients to make sure you identify it and get it put in. Or find a carrier that can customize it and add it. Claims information, we talked about this already. I think the one takeaway is you can use it as much as you want. Whether you want to be extremely active in going through the information, finding the insights, bringing them to your client, and driving costs or whatever it is in a certain direction that you want, you can do that. And the other takeaway is that each carrier is going to give you a different level of information and reports and access to that information, so you should be asking that question that's important to you in terms of what do I have access to and when. Renewal negotiation, we talked about this as well. I think, especially coming from the ACA side, you don't have any control over what your renewal is going to be, right? It's not going to be specific to you as a group, is really what I'm saying. In level funding, it is. to an extent, right? They're going to pool some of it and things like that. But more or less, just at new business and renewal, your rates are going to be based off of your performance. At new business, it's based off of your expected performance because they're guessing through, it's just an educated guess through underwriting in most cases. But at renewal, they're going to base it more off of how you actually ran, how their block of business ran, however they're going to calculate their renewal. But through the claims information you're getting access to, you should never find yourself, hopefully, in a situation where you weren't expecting what you were about to get. It can still happen because you can have bad months at the end of the year. But typically, if you see that you're running poorly, you should be preparing your client to have that conversation. You should be preparing to make your arguments to the carrier at the time of renewal and negotiations. But you also should be talking to your client about, hey, we should be prepared to shop this or transition back into the ACA block. These are all things that we should be preparing for. So you want to be proactive in the middle of the year and know what's coming as best you can. Surplus potential. This one, it's an advantage in the sense that you can share in the success. I would not get caught up on surplus share amounts, right? 100%, if you look at a quote and one quote says you're going to get 100% back of whatever is left over, and another quote says you're going to get 50% back of what is left over. The one that is 100% isn't necessarily going to be better. It isn't necessarily going to be worse, but you also need to pay attention to how much is going to the claims fund. What is your aggregate stop loss? What is your individual stop loss? All of those things are going to determine how much money you might have at the end of the year, right? And if you are in a situation where, maybe you're picked a carrier that has 100% return with half the money in the claims fund and 50%, you're getting 100% of nothing instead of 50% of something. So it doesn't mean that either is better than the other. It's just pay attention to where they're putting your money prior to when you purchase the product, and then the percentage is going to come into play. But really, you never know how it's going to run. You never know how it's going to end up. And I wouldn't necessarily be selling these products on the surplus potential. I think it's more about the insight into information, access into information, having rates that are based off of how you perform, and having the ability to impact that performance and impact costs long term. That's how I would sell it. And if you get money back, you get money back. But if not, you're getting something that's based off of how you perform and what is and necessary for you. And that's the long-term control aspect, right? So all of these things play into it. You get access to so many different pieces, and you get so many different advantages relative to ACA that you take a little bit of that control back and put it into the hands of yourself and the client, right? However proactive you want to be. Any questions on this stuff, talking conceptually, before we get into more of the actual details? Okay. So just a little bit about the products that we're seeing out there. Typically what I see is, and the way that I refer to it, is a bundled approach and an unbundled approach. I'll get more into the details of exactly what that means, but just if you're thinking bundled, think a carrier that provides everything from the top down for the services of the plan, right? They're doing the administration, it's their stop loss, it's their networks, it's their PBMs, and they're doing their own underwriting, right? That's a bundled carrier. So that would be examples of that, like Aetna Funding Advantage. Anthem Balance Funding, not in the state of Texas specifically, that's the Anthem of California, Colorado, which is what I work with out there, but they're in a lot of other states as well. Signal Level Funded would be an example, Humana, and UHC. So when we work with some of these carriers, these products, we consider them to be bundled. They're providing the services top down. They're providing full coordination of the plan so that all the documents, everything in there is lining up. On the other side, there's the unbundled. Allstate, formerly National General. They're more, and when you think about unbundled, it's kind of like a spectrum between fully bundled and fully unbundled. Some of these options might just lease a network and do everything else. Some of them might lease a network and use an MGU and not have their own PBM, things like that, right? So some of them could be closer to it. But typically, some of the options we're seeing out there that we're working with are Allstate, Gravy, Insurgency, Assured Benefit Administrators, working with Healthy Choices. There's 90 Degrees, there's Allied National, there's a bunch of different TPA options. Those are all typically what we refer to as unbundled option. So let's look a little bit more at that bundled approach versus unbundled. Right? So when you look at everything that happens behind the scenes within the plan, you're going to have a carrier, think Aetna, UHC, Cigna. They're going to handle the administration of the plan and the administration of the claims. They're going to have their own underwriters in-house doing the underwriting. They'll use their own networks, right? So if you want to go out and you want to get an Aetna product from Aetna and do Aetna Funding Advantage, you have to pick between the Choice POS2 and whatever the other local network is, or it has to be their network. They're not going to go unless you plug in Cigna's network. Typically, they all own their own PBMs now that might have a different name, but it's their company, and they utilize those in the plan. You don't have an option to go and quote out different PBMs and get into carving that out, which is starting to get popular these days. You have to use the PBM that they have. Same thing with the stop-loss. They're going to provide stop-loss protection. Some carriers might have reinsurance on top of that. It's separate. So typically, the first dollar coverage and stop-loss is going to be provided by the carrier. And then they'll have their own bonus program. And all of that's going to be offered as a really nice, packaged, level-funded plan. And they're providing all the coordination of that product. On the other side, with unbundled, is when you start to get different entities and different players in the game that you can go out and plug in into these different pieces. So you could go and find a TPA. Oh, hold on, looks like there we go. You can go out and use Meritate or Resources or Acuity or Ally or whatever the case may be. You can plug them in and say, I like working with this specific TPA and this is the product or this is the TPA that I want to handle the administration of my plan. You can also partner with MGUs, right? Or a carrier partners with MGUs and has them do the underwriting for the plan. A couple of examples of the carrier work with here, or MGUs you work with, Sus and DRN, Strategic Underwriting Solutions, Dallas Risk Management. They provide underwriting services for some of these different products out there. They'll underwrite the plan and have the relationships with the stop-loss carriers. You can go out and lease a network, right? So now, if you're building this, instead of being, having only the choice of Aetna's networks, or UHC's networks, or Cigna's networks, if you're working directly with one of those carriers for their product, some of these different options will have different networks that they can plug in that could be a better option for your client versus the ones that you would be restricted to with a carrier working directly. Same thing with PBMs. This is starting to get interesting. So we've even been working with some vendors who will quote PBMs inside of a quote for level funding. So you can go through the TPA-driven model, which gives you flexibility and choice. Those are positives. You can go out, and we've been working with some of these vendors where they will go in and they will quote the different PBMs for that specific group based off their experience, and then suggest plugging in a specific PBM that would be the most effective. Stop loss, this is another bigger piece too, and an advantage, I guess, when you go this way. If you go through, let's say, back to the bundled approach through an Aetna or a Cigna, you're typically going to have to ride that book of business, ride the stop loss, and that goes on their paper, right? So when it's doing good, it's doing great. When it's doing bad, it's not doing so good. And you might be beholden to that. But if you are using a TPA-driven model, typically MGUs will have relationships with different stop-loss companies, and they can shop the stop-loss itself. And the stop-loss is a significant portion of the total cost, so it can impact the total cost. And then in terms of wellness and care management, this is where you can get very, it can get very interesting, and you can input a lot of different solutions. But you can go out and you can pick different programs to implement into your plan as long as the carrier you're working with, which typically most of the TPA models will accept, allow you to do so. So those are the differences between the two. The pros are that on the bundled side, you don't have to worry about the coordination. All that's going to be handled. Everything's going to line up perfectly. And document, SBC, and everything, stop loss coverage. On the unbundled side, you gain choice And you have the option to pick things that may be unique and different from the bundled approach, but you also then have to worry about the coordination of the plan. Typically, you can get past that by working with vendors who have great track records in coordinating these things, and that's who we try to partner with. Any questions on the two different types of models? This is what they're doing behind the scenes. On the front side, to the client, to the employer, it's more or less the same. Okay. I'm not sure when I started. We'll just keep going. Okay, risk rating. So again, we talked about you get away from community rating, right? On the ACAs, and this is really important because it impacts a ton of different things for both experience, requirements, timeline, everything. On the ACA side, you can go to any rating engine, right? And you can quote a group as fast as it takes you to go through the system to run the quote. That's not the case in level funding. In level funding, the rates are going to be specific to the group. So what that means is the carrier has to actually review the risk and assess the risk in insuring that group. And your rates are going to be based off of that. That takes time. You have to send the RFP to the carrier. They have to review it for however they want to. And there's different methods for them to actually assess risk, which will impact everything, as I said before. So let's look at some of the different options that we're seeing. The first is individual medical questionnaires. Probably everybody is familiar with this. It's the old school way of underwriting. Every employee in the plan is going to fill out an application for themselves and their dependents and answer health questions. IMQs take a long time, right? You got to track down every single employee if you're doing it the old school paper way, just PDFs. And there's, you can have a lot of different back and forth with the carrier. You can have people that don't complete certain parts. You can have illegible handwriting, things like that. And so it can take a long time. It can take 2 to 4 weeks to go through that process. So if you're working with a carrier who uses IMQs, you have to be expecting that that's what your timeline's going to be. You should be preparing your clients and the employees for the experience of going through it. Now, the positives of IMQs, although they are not convenient, they are very comprehensive. It's one of the only types of underwriting that's truly capturing past, current, and future risk. Have you had any surgeries in the last 5 years? What medications are you currently taking? Is anybody pregnant? Right? So you're capturing things that typically other forms of underwriting are looking back and projecting forward, or they're creating something moving forward by looking back. It's really interesting. We'll get into it. But typically, this is the longest form of underwriting in terms of timeline. A GRQ is basically the same thing, except for you're going to have an administrator in the group answer questions on behalf of the employees. It's not, hey, go out and ask and call every single employee and ask them all these questions. It's basically just, if you know anything that pertains to these questions off the top of your head, answer it. Right? So it's not very comprehensive at all. It's not very difficult to do. And so typically it's not used as a standalone piece of underwriting. I've seen carriers require this, Anthem has in California, Colorado, and other states, where they will use GRX, which we'll talk about, and then also make somebody at the group complete this, just to capture some of those big items, like is there someone that has cancer currently, if not working, or whatever the case may be, to capture some of those catastrophic things. Experience is another kind of old school way, and this is typically used for much larger groups, right? So the groups that have experience. When we're talking about coming from the ACA and funding, we typically don't have groups that have much experience. Sometimes you have a group that might be on a level funded product for 1, 2, 3 years, and they do have access to monthly claim reports and large claim reports. And you can provide that to the carrier. What they're trying to do is use past cost to predict future cost. So they look at your experience and they say, here's how they run. If you only have 1 year of experience, it's difficult because you don't know, is that relatively good for you? Is that relatively bad for you? So typically they'll want multiple years of experience. So you'll provide them these reports 2, 3, 4 years back, and then they'll use that to predict cost in the future. Not as difficult as IMQs, you just work with the group administrator to access that information, and the employees are not part of that process. GRX and Curve is something that has been newer in the last, 3, 4, 5 years that big carriers have started to use. Typically, you only see the larger carriers utilizing it. It's very expensive to do relative to some of these other forms of underwriting. But basically, and Curve is kind of like GRX 2.0. Some of the carriers use that. But basically what GRX does is it uses de-identified prescription histories on individuals, right? You take a census, you run through the system, it pulls these prescription histories, ties those prescriptions to certain conditions, the conditions to certain levels of risk, and the risk to a score that's used by the carrier to then apply to a multiplier on the base rate. Is how it's done, as a gist. And basically, there's some problems with it. The best part about it is that it's very convenient and very fast, and no employees have to be involved. So technically what you would do is you would run a census through it, provided by the administrator, and then you would be able to. The problems with it is that sometimes, of 100, let's say you have 100 people on the quote, you might only have 60 people show up in the report. So you have 40% of the people missing from that report. The other piece is that it's difficult to look at a prescription and know at what stage of the condition is that person in. Are they in remission? Are they continuing to have ongoing high-cost claims? Is what we're relating that risk for that prescription to, are they really using that prescription for the highest level of risk that prescription could be used for, or is it for something else? So there's, I think every carrier that uses it understands that, and they implement policies to try to take care of that. And for instance, when people don't show up on a report, some carriers will say 80% has to show up on the report, otherwise you can do IMQs. A lot of carriers that use GRX also say for groups between 5 or 10 to 20 enrolled, you get to do IMQs, and then everybody above that can use GRX. But that's the most convenient way to underwrite 3 to 5 business days in non-fourth quarter. It can be 5 to 7 after, compared to IMQs can be a lot longer.
So if somebody doesn't take any prescriptions, is that pretty well, that could be mean that they don't show up?
Potentially. I mean, to be completely honest, I don't have much experience with the inner workings of it. I've just had the conversations with carriers around potentially how it's working, but yes. So for instance, the way that it works is on a census, you might have myself, right? So it's going to look for a Connor St. Clair with this date of birth and this gender in this zip code. There's not going to be 2 of those in that zip code, right? So it's using all that information as a pseudo social security number, finding that person. If I don't have any prescriptions, I would imagine that it would either show up with me not coming onto the report, or it would show up with me coming onto it and notifying that I don't have any prescriptions, or that I'm actually not taking it, but they found me, right? That part is a really good question. I don't know exactly how that part works, but that's in general how GRX is going to be functioning. Any other questions? Yeah.
I'm more on the individual side products and disability. Scripps check has been around for a while, individual underwriting. And the problem with it is there's about a 10 to 15% off-label use of prescriptions. So somebody getting a prescription for Eligibility could be depression or IBS. There's no way to know by the prescription they're taking what it's prescribed for.
Exactly.
Because these lists, I've seen them. Some people can be on 5, 10, 15 prescriptions. You have no idea what the other like.
Yeah, there's a wide range of.
I've got questionnaires on those.
Sorry, what was that?
I've got questionnaires on those people to identify what drug, what use.
Yeah, I mean, that would be kind of a combination of the two. Typically, we see GRX being used as a standalone. At least nowadays, it used to be used with, in conjunction with maybe like a GRQ. But I will say this, there are gaps, let's call them gaps. The carriers are aware of that, right? And so typically the gaps tend to have a bigger impact for smaller groups. So typically, on a smaller group, they're not going to run GRX. They might say, we're only going to do IMQs. And a lot of the carriers did that. Anthem was doing it from like 10 to 19. In Colorado, UHC was doing it from 10 to 19. Humana does it from 5 to 9. They're all using IMQs for those smaller groups, right? They're putting a minimum threshold on when they'll use GRX. So I think they're doing what they can to mitigate that risk on their side of the gaps, the perceived gaps and the actual gaps for the unknowns, right? But they're trying to make it convenient versus invasive and really difficult to get done.
So I just had a conversation with the carrier that I'm not going to mention their names, but instead of doing the questionnaire process on a 20-plus group that we do the GRX, they made you go out and get waivers from each employee to do the GRX screening, which is basically the same kind of process, just on a GRX level.
Yeah, and I haven't seen that with GRX before. Any carrier that's using the actual, there are other types of underwriting that are similar to GRX where I have seen that. Where they'll go out and make sure they get a waiver, but typically with GRX I haven't. But I know what you mean. It doesn't make any sense. But I think the most important piece is they're trying to make it convenient for these groups. They know that if you go and say you need to have 70 people complete an IQ, you're not going to get many people to do that. Most groups will say, "We'll try our luck somewhere else with something to do." Right? So it's interesting as it evolves, but I know that they're doing more and more with the service GRX itself to address some of those gaps, but I couldn't speak to them in detail. Proprietary tools. So if you've ever worked with Humana and they've told you about what they call Array or HRAE, it is Humana Risk Analytic Engine. And it's basically something that from an experience standpoint for the client is very similar to GRX. You take a census, you run through a system. From what my conversations were with them, they use prescription histories, they also use medical claim histories, and then they also are taking historical data on groups or individuals that they have been with Humana in the past. And they're using all of that plus potentially other information to then produce something similar to GRX where you're getting such quote. It could be. I mean, that's not even that far off because I've also, one of the things that we do is we work with a lot of different vendors, so a lot of times we'll have conversations with even what I'm going to go through next, which is new types and methods of underwriting. You come across a lot of interesting ways to get things done, and I have heard and know of some types where they are pulling information like that, which is scary to think about, but they're doing it. So this last one is predictive analytics. So if anybody knows AMS, right, they have a ton of information on self-funding groups, millions of data points. They came to us with a new tool that they're trying to bring into the market. Basically what it does is they have identified a gap for groups coming from the ACA to level funding. What is that gap? Well, you don't have any claims experience, right? In Texas, that might not necessarily be the case. You're not going to get something super detailed, but typically around the country, you got nothing. So what they're doing is instead of pulling identified information on me, Connor, and finding Connor in this zip code and his prescriptions so that they know that my actual risk, what they are doing is taking the same census and saying, we have 1 million data points on a male who is this age in this part of the country, and we know that on average they cost X. And they're backing into claims history and creating claims experience for a group that had. It's not actual risk because they're not pulling actual data that's specific to me, but they are using millions of data points to then identify what the actual cost would be for somebody in that location and creating then a yearly claims experience for them that they can provide to a carrier to underwrite, like experience underwriting. So there's a ton of new ways that are out there. I kind of want to keep reading. I'm sure we'll get more, but I would just say what you're typically going to run into is GRX, experience, and IMQs. For IMQs, the old way to do it was by paper. There are a ton of new technology tools. Warner has one as well. There's ones like Ease and eHealth apps, and FormFire is used, I think, by Aetna, or at least they did in the past, where you can go on and employees can log in and complete the applications electronically. So you force them to complete everything, and you force them to, the information you're getting and what they type in is not going to be something you can't read. So it's just a way to help with the distribution, collection, and completion of the applications. Any other questions with this stuff before we move on? All this is important because depending on the carrier, right? If you go to 10 carriers and you have one group, you say, I want to quote these 10 options. 3 of them might do IMQs. 4 of them might do GRX. A couple might do GRX and a GRQ. Those are going to be different requirements for each carrier. You got to keep all that straight. It's going to be different timelines, and you could get different results. So it's very interesting. You got to make sure you understand what they're going to require, and those can change by size of group, by current coverage, which is why it's great to work with the GA on that stuff. Like water. I had to do it. I know I'm not supposed to. I just had to do it. Okay, let's talk about the rate breakdown. I think another interesting thing is when you look at a level funded product, every carrier is going to call the different factors of their rate something different, right? They all have their own spin on it. Some might have 4 different factors that make up a total tier. Some might have 2, 3, 5. Typically, there's 5 that we see that are going to exist whether they're grouping some of them together or not. The first is the claims fund. We talked about that. That's the portion of the money that you're paying a premium that's going to go into a claims fund or be used to pay for claims until StopLoss kicks in. Then you have terminal liability, right? We talked about how Runout is included in this. And if you're in a small group in Texas and they don't have Runout included, you should ask questions about why it isn't and maybe not do that. You want to have... It's more, when you're doing no Runout, like that's more like self-funding. Do like a 12-12, right? And then you can purchase Runout mid-year or you can get run-in with the next person. You should have Runout included, terminal liability coverage included in whatever option you're looking at in small group. And it typically will be. But really what that is, before I move on to that one, is money that's set aside to pay for claims that were incurred while you were there, but get paid after you're gone. Individual stop-loss, money that's put aside. This is typically of the 2 stop-loss portions the most expensive because you're going to have some people typically that may hit the ISL, and if they do, they're going to hit it hard. That money is set aside to pay for the individual stop-loss, which is protection against a high-cost individual member. Each member has their own tab, not employee. Each member has their own tab that is accounted to them, and they will pay above a certain dollar threshold for the rest of the year on that individual. We'll talk more about how that works. The aggregate stop loss is going to be a smaller portion. When you look at the factors, it'll be much cheaper relative to the ISL. And that is just going to be money that's going to be paying for the protection of high-cost claims for the group on the whole. So once you get over a certain percentage of the expected claims, aggregate stop loss will kick in and provide protection. And then the last is admin costs, right? So some carriers might break out broker fees. Some might include them in this. You'll have your network stuff in there, the cost of the administration of the plan. But typically you're going to have these 5 factors. And carriers are going to call them and group them into different things. This is an example of how Aetna does it. Admin fees. Then you'll have a factor for stop loss, but it will include both TRO and the aggregate factor. Then you have, this is Anthem, California, Colorado, Georgia, Washington, not the Blue Cross Blue Shield, Texas. But this is the way, it's just another good example of how they do it. They have the same 5 factors, but they're just calling it slightly different things. This is how Cigna does it. They'll give you 2 separate pages typically. They'll give you 1 page that breaks it down into 4, giving you the ISL and the ASL split out. And then they'll group it into admin and insurance, which is exactly what Humana does. And what UHC has done on an annualized basis on their quotes, they typically haven't shown a breakdown on a 4-tier rate, but you can get that rate, at least when I work with them in Colorado. And I'm sure that it could be something that they could buy. But it's basically a breakdown further than just the 2 factors. Any questions on that before we go into how it works, which I feel like already. Okay, so takeaway from the previous one is when you see all these different words on all these different quotes, don't be alarmed. It's the same stuff. It's just they're calling it something different. You just got to figure out what are they putting into those different factors, and then you can make an informed decision on, okay, now I know my money's going here for this and this and that, and then be comfortable with it or not. Okay. how it works. So last three pieces, we're going to go through stop loss, we're going to go through surplus and deficit, which is really easy, and then we'll go through runout, which tends to be the more difficult one for people. Always the fun one to explain. So individual stop loss, you're going to see it on a quote as a hard dollar amount, 20,000, 30,000, 40, 50. Some carriers only will give you one. They'll say, no matter what, we're going to give you 30. Others will customize it. Most will customize it these days to what should be working best for the group. But you'll see it on there as a hard dollar amount. And what it says is that the employer is going to be liable to pay for claims up to a certain dollar amount per member. At which point, after that, for the rest of the year, remainder of that 12-month period, the individual stop loss protection that you're paying for will kick in and pay for the claims for an individual. And it will no longer come out of the claims fund, right? So imagine you didn't have that in there, it's called an aggregate only product. I wouldn't necessarily recommend it for small group, but you can have a product in there that doesn't have it. It's not typical. But if you didn't have the protection, you could have one person eat through the entire claims fund, right? So you want to have it in there to protect you from that one or two different individuals that's going to have high cost claims. So you have money left over to share at the end of the year. So typically what's going to happen is while you're moving through month to month, different people are going to accumulate different rates of claims, right? So some are going to have low, some are going to have high. As soon as somebody hits the 30K, then it kicks in, everything gets paid for that person for the remainder of the year, and you keep moving forward, right? So everybody has their own talent.
Is it around that part of it, ISL kicking in, that you tend to ask for eligibility under the plan?
I'm not necessarily sure the answer to that. So you're talking about asking for the eligibility for the individual?
Yeah, like confirming that that person who triggered stop loss was actually eligible under the terms of the plan and not just paying it out.
I guess you could, yeah. I mean, go ahead.
So, yes, the majority of the carriers out there probably spend. They'll investigate, sure, that is an eligible.
And if they fail to do that and pay it anyway, then it's on the stop loss carrier.
Yeah, well, file their application. There was IMQ statement on the group, and the employee lied, didn't disclose all this information. They would rescind the coverage on him.
Typically unbundled.
Because they're the plan administrator. Remember, it's an ERISA plan, so the owner of the plan is.
Thank you, Chair. All right. Alternatively, you get the ISL in there, then you're also going to have the aggregate coverage. The aggregate coverage is going to be represented as a percentage. So you'll typically see 120, 130, 125. And that is providing you protection above a certain number. Right? So we talked about expected claims through underwriting. They're trying to project risk and project cost and come to an expected level of claims for the year. Your claims fund is not going to be equal to the expected amount. It's going to be equal to a certain percentage of it. In this example, 120%. So that's your maximum liability set by the ISL on the group level, and you will pre-fund to that amount, right? So if you run out of that money, you're not going to be liable to pay anymore because, like we talked about as the very first thing, pre-funded max liability. They determine the max liability, force you to fund it on a monthly basis, and then you now pay your maximum liability and you don't have to pay more after that. Everything above that 120 is going to be paid by the ISL. Any other questions?
Any specifics?
Yeah, I have another presentation that goes through that. I haven't necessarily seen, especially, since we're focusing on level funding in small group, I haven't seen the use of that widely at all, the aggregating specific deductibles. But it's basically an additional, for those of you who don't know, it's an additional layer of risk above the ISL that accumulates and then before the ISL protection kicks in. It's kind of the easiest way to explain it. But you see that being used as a cost And you add one of those in so that you can bring down the cost of the individual stop loss because you're taking more risk on top of it before it kicks in, instead of paying it in, basically. But you see that more with not necessarily in small group or towards kind of self. And then you can do lasers on some of these things too. Might as well hop into that. Where you're basically just lasering somebody out and saying, instead of getting the 30 like everybody else, you're going to get 50. So I'm going to pay for you up to 150 or 200. Everybody else is going to still be on that 30. It's a way for you to, again, take on more risk, lower the premium than what you'd be paying in stop loss, and paying for that person at a higher dollar amount through your claims fund before stop loss kicks in. But those, again, when you're looking at a level funded product in small group, you're not going to really find that.
What happens if there's a deficit of X month in terms of enrollment? It's down.
It's another more self. Yeah. So typically, like, you have a certain amount that you have to hit, like a minimum attachment. And if you don't, then you're liable for paying up from that point to the minimum. Otherwise, you're liable. Right. So again, more of a self-funded concept. Most of the carriers, we are working with the larger ones. I've seen, even in COVID, we saw a lot of these groups lose enrollment. I did not hear at all or deal with that specifically myself with some of the larger carriers. To get into more boutique carriers, sometimes that may be something that is an issue that you need to worry about. And it doesn't mean you're worrying about it, it means you're addressing it and you're aware of it. But losing enrollment mid-year, yes, there is a certain amount that they want as a minimum attachment to provide it, and you have to hit that. So it's definitely something to be aware of.
Another thing that I've said that will warn you about is rates really low for dollars. Cost to cost. But if you see a really low, and I've seen one of the providers, not the name, they'll go in with a contract. Pretty cheap, but start talking about it.
Yeah, you call that a red flag.
You really need to understand how this works.
Yes, so there's some, and again, most options that I've seen, you're not going to have a 12-12. You shouldn't, if you're a small group. You should have something where it's like 15 months, 48 months, 17, 24, 6 even. Just not 0, right? Because if you don't purchase it up front, then they're going to make you pay for it based off of your claims. And if you need it and you're trying to get out, it's going to be a lot of money because they're going to base it off of how you're currently at the point in time, so they can see how much they actually need. But if you purchase it up front or buy a product where it's included, like these typically, the larger carriers, even the cheap ones, if you see that they have a 12-18, that's going to make sure that you have a certain amount.
Well, I feel it's kind of my responsibility to let people know that that we actually track claims past the 30th month. Because, I mean, there are a lot of contracts out there, 12-18s, 12-24s, and we've actually paid out $2 million past the 30th month, with the largest single one being $90,000.
Wow.
In under groups. So it does happen, and you don't see it in fully insured because it's all happening behind the scenes. You never, and it's things like medical clawbacks and things like that that typically you're not exposed to. So, it's small group. My counsel is to err on the side of caution.
Yeah. So, just thinking.
Time's up.
Okay. So it brings up a really good point, and we'll get into the runout lengths and the period of runout, but it's important, right? Some carriers will say that our data is telling us X, which is why we are doing Y, right? And you'll have different lengths of runout that you might pay for, but is it appropriate and is it necessary protection or is it not, right? I would always say err on the side of having more coverage, right? There's no reason to try to nickel and dime and get away with a couple $extra because you wanted to have a shorter period. Right? So each carrier will have different contract risks. We'll get into that in a second. Let's talk about a surplus and a deficit. Really simple stuff. There's a lot that goes into this, and when I say a lot, I mean some carriers will fund the terminal and have it be something you pay for throughout the year. Others will take money out of the claims fund before distributing it back based off the percentage of the arrangement. So this is more just a basic example. It's not necessarily how it's always done. But let's say you have $120,000 you put in, you had actual claims of 80, and not accounting for all the stuff I was just talking about, let's just say you have 40 grand in there. Is that what you're going to receive back? Not necessarily. Yes, it could be no, right? Some carriers might take the portion that they deem to be, some carriers will do like a percentage of the monthly claims fund in month 10, 11, and 12. Some will do it in month 11 and 12 and pull it out of this before returning it. So there's some different things you have to be aware about, but in general, if we're just looking at the math, 40 grand, some carriers might give you 100% of that back. Some might keep a third and return 2/3. Some might keep half, right? After some of those pieces were taken care of. So it's important to know what your arrangement is in a contract, but again, like we talked about, 100% isn't always better than 50, 50% always better than 100. You just need to be aware of the numbers behind it. In a deficit, we'll take the same example, 120, let's say we're at 160. Really, that's just going to be covered by stop-loss for the year. But let's just say that we had a deficit. Would you be responsible or liable to pay for this? No, right? Again, going back to the very first thing we talked about, pre-funded maximum liability. Basically what it means is I already gave you everything that I'm responsible for. So you wouldn't have to come back and pay that 40 grand, but it doesn't mean that it's not going to impact your removal. Right? If you're running poorly, we talked about this as well. Be prepared for that. It's going to impact what you're going to receive. Just like, when they're looking at the business, you have high cost claims, or they see something on GRX, you're going to get help, right? After your experience with them for a year, you're going to have some money that
Early termination could be responsible for early termination of the contract.
That's another rabbit hole with a lot of different. Early termination, it depends. Like, if you have already funded up to the max, some carriers will just say that you're walk away. I've had some carriers do that. Some other carriers will say you're responsible for funding the terminal for the following months, so that we have enough money for you to exit and then pay your buyout following leave, and everything else will be incurred. So it depends, right? But it's another good question, right? You guys are more into this stuff than I was anticipating. I should have brought a different presentation. This is the basics here. I've got like 6. All right. Let's talk about these and then we're done. Okay, so you're going to see on each quote, right? Like UHC might be like a 1260. Aetna might be a 1260, or they'll say it's a 1212 with 48. Or Cigna will be a 1212 with 15 months to make it a 1227, right? A lot of numbers being thrown around. What it is, the first is the policy year, so you're typically going to have a 12. In small group, that's pretty much what you're going to find. Some I've seen do a 15-month, where they do 3 months and they reset it, regardless of how you're doing, and then they run a traditional 12 to get you off cycle of that terrible time of year. But typically you're going to have a 12-month policy year. In this example, so at 1218, that's going to be your claim payment period. The difference is going to be your runout. Right, so it might be a 12-12 with 6, meaning you're going to get coverage during the year, and then when you leave, you'll get coverage for everything that was incurred while you were there, but gets paid after you're gone. A 1224, you just do the math again. The difference is what you're going to get. Again, they can present this in different ways. Most of these, they'll have 1224 or 1236 or 1260. But some may say, and I've run into it, brokers have asked in the past, I thought that this was a contract that had, some runout protection, and it says 1212. Really, to read the fine print, it says that 15 months of term reserve will kick in, I believe. Otherwise, it renews to a paid contract 2412, 3612, Infinity 12, until you leave. So why is it important? I think it kind of introduces the first concept, like when you're not fully insured, you don't really have to worry about when things get paid, right? You just purchase the coverage. The carrier is assuming the risk, right? The transfer of risk happens, and it's the carrier's liability to pay for claims, pay being the operative word. When you move to self-funding, you are responsible for paying for your claims, regardless of when they need to be paid. So you then have to make sure you have coverage for the administration of that claim, the stop-loss coverage of that claim, the payment of that claim, setting money aside for it, for instances where something like this happens, right? And this is an example that really doesn't happen anymore with the electronic adjudication of claims. This timeline is very much reduced. But for the sake of the drill, you have a surgery that occurs in the first month. It doesn't get billed until the 10th. And then you leave the contract after the 12th month and it gets paid in the 4th month after. If you were on a 12-12, you have coverage for things that were incurred during the 12 months and paid for 12 months, meaning it wouldn't be covered. You'd have to either purchase Runout or go to the new carrier and purchase Run-In. Or if you were smart and you had Run-In included in the contract that we talked about, and you're on the 12-18 or even a 12-24 or a 12 anything greater, this would be covered, right? It's just as soon as you leave, Runout kicks in, protects you for everything that happened while you're there, but is going to get paid after I'm gone. That's basically how it's working. And Run-In is obviously the opposite of that. You're pulling back, saying I want all of these claims behind me, X amount of time to be covered in this contract year that I'm in with you. Regardless, if you don't have Runout or Run-In and you're on 12-12, somebody's going to make you pay for it if you need it. So if you are on a level funding product in small group, pick one that has Runout included. That's a lot of them.
This might be getting too much in the weeds, but if you have a run-in with one carrier, are they going to actually respect the adjudication of the previous carrier in the run-in process?
Well, I think it would be something that you wouldn't necessarily, you want to be on top of that to make sure that doesn't happen, right? So if you're moving to another carrier, you have Runout, you don't have a necessity for Run-In unless there's a disparity in time that you want to get coverage for. I'm sure you can go through that. But when it gets down to that, I wouldn't necessarily, from my own experience, know exactly how it would be handled. But I would say you would want to avoid being double, having double coverage, it's like the NFL or something. And that's it. I know there's a lot of it's kind of dry, but you guys were great. You guys had a lot of good out there too. And you asked a lot of questions. I should have brought the self-funded presentation. You guys literally hit every single thing I had.
I do have another question because this is one thing that I think that sometimes clients don't understand. It's core fee, continuation. I mean, these are not state mandated plans.
Mm-hmm.
So state mandates do not apply. The employer is responsible for
Core fees, the 1095s. So certain carriers in small groups especially will handle some of the 1095 reporting for free. And they'll do a portion of the administrative part. But there are PCORI fees that you have to pay that need to be calculated. Certain carriers will help you with that. But you are responsible for those things outside of an ACA plan. So it's another good piece, a little bit more advanced, but it's something you're responsible. So for state continuation, I know that there's the whole federal COBRA state continuation piece. Certain carriers won't touch it, like some start above it. So it's a carrier by carrier piece that I would highly advise just understanding on that basis, because some, just like the rest of it, reporting lines and things like that, you can't just purchase these and walk away. You do have some obligations, and some carriers will take care of those obligations. Some won't even bother with it. So I would advise that you figure that out on a carrier by carrier basis about how to handle it. Great questions. So. All right, anything else? Okay, well, thank you guys. I appreciate it.